What's up, everybody? Welcome back to Earn It, Save It, Invest It. In this video, I'm going to break down what I think the stock market's going to do in 2026. I'm going to go over kind of historical numbers, how it's performed in the past, as well as what I think personally it's going to do. It looks eerily similar to another year, so I'm going to kind of just break it down really quick. So please give a like and subscribe. There it is. Like and subscribe if you do like this stuff. And yeah, let's just break this down really quick of how I think the stock market's going to perform in 2026. So this is my portfolio right now. It's my $100,000 challenge. I'm currently at $8,684. These are my holdings. I'm not going to break down this really that much because it's more about the market, how I think the market's going to perform. But this is my holdings. One big thing about we have to keep in mind is politics, obviously, right? We had an election year, not last year, but I mean, last year was the first year, right? But the year before that was when we had the elections. This is another election year, midterms. So I decided, well, what is it going to be like? Because this does play a part in how the stock market can perform, especially when you have these administrations that are way different and there's volatility in the administrations, then there's more volatility in the markets. So historically, midterm election years, the second year of a U.S. presidential cycle, have been the weakest for the stock market, often seeing muted gains or even sell-offs. But the weakness is typically followed by the strongest market performance the year after the midterms. The significant average rallies as uncertainty resolves. The midterm period can be volatile, but post-midterm, the S&P 500, Dow Jones have shown robust average returns, often exceeding other years. So essentially, they're saying midterms are going to be not great years. Right? Year one is right after the election. There's moderate returns, which we did. We had a 20. Right now, we're sitting on about 20%. Or so. Year two, weakest part of the cycle, potential for volatility or flat performance. That is what we're in right now. Pre-election, that is next year. Right now I'm recording this in the very end of 2025, but I'm pretending it's 2026 at this point. Next year, 2027, it's essentially saying we should be seeing the strongest returns. And year four is election year, good returns. So now this is just historically how Google is, just kind of kicking out an answer right now. But I decided, well, let me see exactly how it performs, right? Let's see how this really performs. Because is this true? Now, I went to 1990 because we have to understand, even though the stock market and politics has always been a thing, at least for the last, 100 years or so, right? The way things are done. Basketball, for instance, right? It's one of my favorite sports. It is my favorite sport. The way that basketball was played, the way it was scored, the way it was tracked, everything. From the gear they played, from how we watched it, to the rules, everything has completely changed, right? The averages. The average amount of points a player is going to score, the amount of points on average the team is going to score or a game is going to have, has gone up tremendously. The amount of free throws, the amount of three-pointers never existed 50 years ago, right? So it's like, maybe it's 50, yeah, but I'd say about 50 years ago, right? So it's just, there have been changes that have happened that make things change. So I didn't want to go too far back. So I went to 1990. And that's why I was like, okay, midterms from 1990, how does that perform? And so these are the midterm election years since 1990. So we started in 1990, and then of course you're going to go every 4 years, right? So we're just going to go every 4 years. These are the Qs, right? The QQQ, this basically tracks the NASDAQ, which kind of started in the 2000. So I think if you know anything about stocks, 2000 was the dot-com burst, the big bubble. So obviously it didn't start out great. But we're going to go back. Let's show these are annual returns since 2000, right? So we have 1990, 1994, 1998, 2002. Now again, the whole section is the .com. I don't think we can really judge it that much. So let's go to 2006, right? 2006 actually had a better year than the one before it, but the year after, better year. And then of course we had the great financial crisis, right? Let's go to 2010. All right, so let's go to, right? It would be 1994, 98, 2002, 2006, yeah, 2010. Now, we actually had worse gains the next 2 years. The next 2 years we actually had worse gains. In fact, you could even say 3, 4, 5. 1, 2, 3, 4, 5, 6. Only 5 out of the 6 years after 2010 were underperforming the 2010 year, right? So midterm actually on 2010 was a good year. Then we go to 2014, about the same, right? 19%, 19%, about, right? So very similar. Let's go another 2018. Now, 2018, we were on the verge of like a 30% gain or something like that, maybe even more. And the stock market just dropped crazy. It dropped about 30%. So that was at the very end of 2018. So we could have been up, instead we're down. Then we go to 2022. We all know what happened in 2022. If you're in the market, it was a bad year in 2022 for everybody, right? Down 32%. And now we're going to be in 2026. Right now it doesn't have 2025 yet. We haven't finished the year. Like I said, we're at the very end of December, but we're looking at about a 20% gain in 2025. So 2026, what is it going to be? We'll find out. This is one interesting thing that I noticed that really caught my eye. I want you to pay attention to the numbers of the gains and how it's changed. Obviously, .com bubble bursted, insane, right? And then of course, in order to make all this back up, it went up 50%. Okay, but since then, 10, 1, 7, 19, then we went down, great financial crisis, that was huge, minus 40, then we went up 54, right? These kind of didn't exactly wash each other out, but kind of. Then we have 19, a 3, a 19 or 18, a 36. 36 seems pretty big when you're talking about not having any kind of big drop, right? There's no big drop in the market, and yet we hit a 36 gain. That was pretty big. And this is just for the Qs, QQQ, right? NASDAQ. We'll go over the S&P. Then we have 19, 9, 7. Now check this out. Other than 2018, since 2017, we have 32, 38, 48, 27, a 32 down, a 54 up, and a 25 up. And this year we're looking at 20, 21. The fact that this year is going to be the weakest year that we've gone up, right? A positive year, because we've obviously had those 2 negative years. This is going to be the weakest positive year since 2017. You're talking 1, 2, 3, 4, 5, 6, 7, 8, 9 years. And it's going to be the weakest positive year at 20%. That is crazy. So that got me thinking, why? How did that happen? And I think the brokerages like Robinhood, I think honestly, Robinhood did this in a weird way. Robinhood made it very easily accessible to gamble on stocks, right? I remember in 2015, I started getting into it, and I started with Thinkorswim, right? TD Ameritrade back then, and I was getting charged $5 every trade, and I was like, this is getting expensive for someone who I was just having a kid, and I was 26 at the time, so I'm like, come on, man, it's expensive to try to like trade. I was obviously like trying to figure out how to invest and how to trade and do that stuff. So I wasn't just like, I want to do long-term trading where I'm putting my money in and then I'm letting it ride. I'm actually wanting to trade. And so it was expensive. Then I was like, wait, what about Robinhood? Because this is free. Then I was able to make all kinds of trades. and lose all kinds of money, right? But I was making a lot more trades. And I think the volatility, because now I can just quickly, I don't have my phone on, wham, right now I could right now start a new Robinhood account. I don't know if I could start a new one, but I could start a Robinhood account if I didn't have one, probably within 30 minutes, and have it funded and start buying stocks if it was market hours. So it's just crazy that we haven't seen anything less than 25% on the upside in 9 years. The only down were again 2018. We were down 30% at the very end. So that, negative point whatever, it looks like nothing. We were up 30%. Now that might have contributed to the 2019, right? 2019 is 38%. So okay, 2019 was that big because of 2018 had such a crash. But then why did we go up 48% in 2020? COVID hit. We went up 40%, 48%. Then we went up 27% after that. Is there going to be a time where we get back to normal, where we go back to these teens? Or are we just going to be rolling in 20s and 30s and then dropping 32, 40%, 50%? Because you have to understand that when we have this upside, it's going to be downside too. The downside is going to be just as big. So this was very interesting to see. That's all. So that's the QQQ. Let's go through the S&P, right? Here we go, S&P 500. So this is the SPY. It tracks S&P 500. It's not the actual S&P 500, but it's essentially has the same performance. Now, we have 1994, so we start there, right? 1990 was the first midterm. 1994 was the second midterm. So 0.4, and then we had 1998, 28%. Now, look at these years. I mean, wow. The 90s were popping. Those were some good years to be investing, right? Until the bubble bursted. Now, as you can see, the Qs were way worse because the Qs tracked the NASDAQ, the tech companies. S&P 500 does not track all tech. It does all kinds of different companies. Therefore, it dropped a lot less. So we will probably see a lot more volatility in the Qs, a lot bigger numbers, because technology is just boom or bust in a way. So then we have 2002, right, down 21%, which was a big one, but that's, again, the tech bubble bursting. 2006, a decent year, right? And then 2010, again, very similar to 2006, just like the Qs, right? The Qs, 2010 and 2006 were almost identical. Then we go to 2014, about 13%, which is good. 2018, again, we're down 5% on the S&P 500, which is actually, right, it's a lot less than the Qs, surprising. And then 2022, again, we all know what happened in 2022. As you can see, these numbers, less, right? They are not as dramatic as the Qs, but they are still significantly higher since 2017. 21 minus 5, 31, 18, 28, 18, 26, 24. Back here, we saw from 2008, because we had the great financial crisis, 36, 26, 15, 2, 15, 32, 13. So a lot of teens. We had a 32 in 2013 and a 26% in 2009. Other than that, nothing else was over 20%. Then we get to 2017, and there's nothing but 20%. Unless we were down. Okay, we had an 18% in 2020. That's pretty insane. So I do think for sure that, I don't know why this keeps coming up. I do think for sure that the stock market is gonna have, at some point, right, we have to hit 15%, right? We're gonna do that at some point. So it's interesting to see these numbers and be like, where can 2026 lie? Because it is midterms. And one thing I noticed, and I want to show you, is when I look at this chart, and I look at what looks the most similar, right? What looks the most similar? It's these parts right here. This right here, right? The big boom, wham, and then a little doot doot. I have wham, doot doot. Right? These two sections, this right here, looks very similar to this. This was COVID. This was the COVID drop that, we went all the way down, and you can't see the date down here at the bottom, but this is February 20, this is right here, yep, February 2020, this is March 2020. So this is just basically 1.5 to 2 months worth of stuff, right? Here, this is February 2025, and we ended April. So again, about 2 months of dropping. And then we just shot up, just shot through the roof, right? And I mean, then we literally went, bursted through, and then we came back down to reality a little bit, right? Come back down to reality, and bop up a little bit. Okay, let's bop up a little bit. And now then we shot our way back down. What are we doing? We're kind of shooting back down. Now, right now, we're actually on our way up, so slightly different. But it does make me think, is 2026 going to be like 2021? Like this, where it went up, 26, well, I have it on here on the charts, 26% or so. Well, let me see what it went up. According, that was the Qs. So, what was it, 2021? 27%, yeah. So, are we going to go up another, 20% and then have a drop off in 2027? Is 2027 going to be our big year where it just tanks? I don't know. No one knows. No one really knows that answer at all. No one knows. But I'm looking at these charts, right? And it looks like we have to have a pullback at some point. But we don't have to have a 2022, right? I mean, you look at all these other years, we're just shooting up still. We have a little bit of a flatness right here. Was this 2016, 2015? A little bit of a flatness, right? And then we've just been shooting up. And like I said, though, we're seeing this big significant impact in 2017. This is where it just pushes up, and then volatility happens. Volatility. And I don't know. It just seems to me that I look at all this volatility and I see that a lot of it's probably caused by the no commissions on the trading. Like Robinhood's doing sports gambling now, I think, right? So it's becoming a gambling thing for people. In 2020, it took off even more. It was already starting to take off with the no commissions. But having it be, just so mainstream, and in COVID, right, where it was like, hey, everyone, you're locked up, you're locked in the home, you're not doing anything, but, there's no sports to gamble. You couldn't even gamble on sports, right? So everyone had to gamble on something. I do think that that's what caused 2022 to be even more so, right? Is that everything got pushed way up, and it was like, wait, hold on, this is not reality. So it got pulled back a lot. But it feels like we're still kind of there. We got pushed up a lot. We had that big tariff scare, right? And then we've pushed up since then. The thing is, the earnings aren't bad, right? The PEs are not bad. So it's not like these companies and the revenues are not going down, right? The revenue growths aren't really going down in some companies. Some of the companies some of the companies in 2022 were going down. Not just down in growth of revenue, but some were actually going negative. More so than right now. So we don't have that problem. And this is why I'm saying, could we be in another 2021 year where we push PEs up more, and then 2027 comes around, like, you know what, we really need to see results from AI. We need to see absolute results before we start seeing these CapExes and so many other things. We need to see more results. And maybe by then, if we're saying we need to see results, but the PE is already really high, that's cause for concern. If we see any kind of revenue growth loss, like if we start to see a decline in revenue growth, that's going to be huge. So these are the things that we do have to work on or be on the lookout for. But earnings are good, business is good, things are okay. The consumers are not in the greatest positions, which is why I think 2021, right? 2021, we weren't exactly all in the greatest position. Things were starting to go up a lot more in price. People were, money-wise, we're okay, but economically wise, we could tell and we could feel things getting worse, and we just didn't like it. 2022 really hit it. Right now, we're facing even harder stuff, even politically right now around, right? It feels like, obviously this current administration with Trump, they have more of a stronghold of what to do there. They have more of an idea of what to do, right? They can be successful at it quicker because they've already done this one time in the past 4 years. So now they're like, they filled the seat before. This is another loop around the block for them. So they can now get stuff done a little bit quicker. We'll see. We'll see how this is all going to turn out. I don't know. You don't know. No one knows. We can only make as best educated guesses as we can do, right? And so like I said, this looks a lot. Let me show you one more time. This right here, this drop, this looks a lot like this. This is 2020. Boom, COVID, then we bounce up, and then bloop, 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 a little bit, and then we just keep shooting up. We have some volatility. But we shoot all the way up, and then we fall tremendously back down to 2020 levels. I see us, we can do a boop, drop down, boop, 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 boop. Okay, then we pop up for more, and then we have another fall, and then we fall back down to these levels. And there is a couple stocks that I already have my eye on, and I know it's not good to time the market, but when markets drop 20 to 30%, it almost doesn't even matter. You buy certain stocks, and I'll go over that in another video. But anyway, yeah, thank you for watching. I know that was kind of a big one. Please give a like and subscribe. If you're watching this still, I really appreciate you. Thank you. You're the 1% for sure. And yeah, let me know what you think 2026 is going to be like. I think we could have, based on history and the way it looks, the way 2020 looked and the way 2025 looked, I'm thinking we could have another 2021 where we experienced some volatility. We had multiple drops, but nothing that kept us back for very long, right? We started the year off with a drop. We kind of pushed up a little bit, and then we fell in February, and then we just pushed back up, fell a little bit. March, where is this? In April again, we went down a little bit, and then we just boomed up since then. And then, of course, we had the little September drawback, and then we just boomed up for the last few months. I think that could happen again. I think that could absolutely happen again. We are in midterms, though, so it's a little bit different, but that could also just mean the market goes up, right? The market goes up, and at the end of the year, we end up at around 20%. So I guess what I'm going to say is I'm not going to finalize this number, but I'm going between 15 and 20%. I want to say 12 to 20, but that feels like too big of a range. I've been on target my last few years, but my range has been about, I don't know, between 6 and 10% maybe, which is, I think, a big range. So I want to do a 5%. So I think I'm going to go 14 and 19%. 14 and a half, 15 and 20. Between 15 and 20, that's what it is. So anyway, thank you for watching. Please give a like and subscribe. Be aware and prepared, but don't be scared of the stock market drops, because it will drop. And never forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.